how this kind of came about is I was listening to a podcast recently with a gentleman by, I think his name is Andrew Wilkinson. I might be getting that wrong. Anyways, he's a venture capitalist, and his kind of focus, if you will, and he's done very well, right? So this is a successful guy, and he makes the comment in this interview that he thinks real estate is a horrible investment, and I thought that was kind of interesting, right? It's contrarian, and I'm not sure. Like sometimes people say things just to kind of stir the pot. I didn't get the sense that that was the reason he made this comment, because he followed it up afterwards by saying, uh, and I'm paraphrasing, so I'm going to probably get some of this wrong, but he's like, you know, I don't know of any real estate business that I can take from 1 million to 100 million, but he's able to do that with a business, right? And I think maybe he's even done this. And so, from his kind of perspective and paradigm, he's looking at things saying, you know what, he really understands how to grow businesses. He really doesn't see the value, or at least that same kind of upside in real estate. And so, I thought about that for a little while. And, I'm not here to debate whether he's right or wrong, because what I want to hopefully share with you is just the thinking that goes into that. And in fact, the book that I'm reading right now, I say reading, but a lot of this stuff I just listen to on Audible. But it's what is it called? Decision making. Here, let me just tell you what it is because I've got it on my Audible here. Thinking in Bets, and it is by a lady by the name of Annie Duke, and she was like a very successful poker player. And what was interesting when I read, I almost got through the entire book on the drive out to Banff with the family this weekend. And what really kind of drew me in was how she distinguishes decision making from outcomes and results. And so, what does this all mean? I'll give you a good, hopefully, metaphor analogy, and it's around Super Bowl 49 when Seattle was playing the Patriots. And if you don't know, I'm a pretty big Patriots fan. And I remember watching this game. There's about 30 seconds left. Seattle is on like the 1 yard line. They've got three downs, and they've got Marshawn Lynch, who's arguably at that time he was like the best running back in the NFL, averaging like 4.5 yards per carry. And so you're looking at this saying, I mean, like there's almost no way that Seattle is not going to run the ball in. And if you remember Super Bowl 49 like I do, what happens is actually Pete Carroll calls a passing play. And I still remember it very vividly because, Belichick didn't call a timeout. Seattle didn't call a timeout. Like they just kind of went with the flow. And, lo and behold, one of the Patriots intercepts, picks off the pass, and they go on to win the Super Bowl. Now, I thought it was a stupid call by Pete Carroll, and I think a lot of people did. However, I didn't understand the stats and the probabilities until I read and listened to what Annie mentioned. And I might get some of these wrong because I'm just going by memory, but it was something like 66% or 66 calls that year on the 1 yard line where they decided to pass instead of run it in. Not one was intercepted. And over the previous 15 years, I think the percentage was only 2% that ball would ever get picked off. And so from a decision making and clock management and some of the other kind of variables and factors that maybe went into Pete Carroll's mind, who was the coach who made that call, you actually see that it was probably obviously it wasn't the right call because of the outcome, right? But had it gone another way, had they scored, had maybe the ball just been dropped and on third down they run it in, no one would even be talking about that. But it was because of the result that happened that people focus on the fact that it didn't work out for Seattle. And so seeing that, and then I took it a step further and started to analyze my own deals. And I'm not going to tell. I mean, you might be able to kind of determine the deals, but I'll just kind of share high level. Uh, One was a project that we did about 5 years ago, 4 or 5 years ago, and when you look at the outcome, it looks like it was a really smart decision, right? Because our investors made, over 30% in 16 months, and it really kind of looked like, why wouldn't you just continue to do these types of investments? Compared that to another value add property. So one was a development, higher risk, and just by the very nature that you're doing a development. And the second was a value add multifamily. And unfortunately, the value add multifamily, even though the logic that went into that decision making in terms of the location, the execution, the game plan, because we did it and we executed on that, but then external factors happen. Oil goes from 120 down to 30. Our property manager has to move out of the country because she has to take care of some family issues. COVID, there's multiple things that kind of were outside of our control, and each one was kind of like just impacted the profitability of that project, right? And so if you just focused on the outcomes, you would say, well, just do more of the industrial development and do less of these value add multifamily, when in reality, when I take a step back and say, like, look at the decision making that went into both of those projects, it's very clear that if I was to do 50 of those deals, 50 industrial, 50 multifamily value add, it would be clear that the multifamily value add on scale, this is just my perspective, but I think my partners would agree that the likelihood of positive outcomes would be much higher on the value add side than on the industrial side. And I won't get into all the details in terms of why, but just seeing what happened after we did our project, about 5 other developers tried to replicate what we did. And I know 2 or 3 of them that struggled immensely. I don't know if they lost money, but it would not surprise me in the least. And so I think, why am I sharing this, is oftentimes we focus on, like, and I'm sure guilty of it myself, where we talk about projects or we talk about investments and we talk about, like, what happened, but we don't necessarily focus on the decision making that went into that. And frankly, especially on social media and whatnot, most people are not going to talk about the lessons learned or the losses or the struggles, because that usually is not self-serving, right? And I personally don't do a lot of that myself, but for other reasons, right? For legal reasons and to protect my investors and whatnot. But I do want to share hopefully the concepts and principles, so that you're able to, if you're considering making an investment decision, asking certain questions. Okay. And so some of those questions that I now ask as a result of kind of, thinking about this, going through various good projects, good decisions, bad decisions. I'm asking, like, do I really understand the investment, right? Like, not just do I understand it? Yes, I understand value add. It's like, do I understand the market? Do I understand the sub-market? Do I understand the demand? Do I understand the competition, the rents, construction costs, what might happen with new rules from CMHC? Like, all these things need to really kind of come into play. Number 2 is, like, am I seeing the deal first, right? Like, to me, that's really important, or at least in the top kind of 3 to 5 investors, because I don't like to compete with 50 or 60 other investors. I don't have a competitive advantage at that point. Am I speculating versus am I using sound investment principles, right? I see a lot of this right now, even more so here in Calgary, where there seems to be a real trend of investors that are buying pre-construction because they're getting guaranteed rents. And there's nothing necessarily wrong with that, but I would just question, like, are those rents real? What happens if this? What happens if that? Like, I think it, frequently, if it's easy and there's a compelling story around it, especially from people in Vancouver and Toronto that have done this type of investing for quite some time. It's not to say that it can't work or it won't work. It's just, for me, I'm looking at it saying, like, am I buying it on today, or am I buying it based on something that I hope happens into the future, right? That's just a question that you need to ask, and I think it's important. And it really kind of, I think, ties into another concept that I've been really thinking about lately, and that is around this question of like, Shane, like, what should I invest in, or where should I invest, or how should I invest? These are questions that come up a lot, and I don't have the answer because, frankly, a lot of it depends, right? It depends on your risk tolerance, your understanding, your knowledge, where we are in the market cycle, how old you are in terms of like, if you're coming into retirement, you're going to take much less risk, presumably, than someone that is in their 30s or 40s and has a longer horizon to ride out maybe bad decisions. So all these variables kind of come into play, and it's what Annie actually talks about in her book in terms of poker and how hands get played and the variables. Like, when they interview some of the top poker players, very rarely do they even talk about what happened after the cards were dealt, because whether they won or lost, because there's an element of luck and chance that you can't predict, right? And she compares chess and poker, and I'll probably get it wrong, but presumably in chess, and I actually like chess, but if I play a grandmaster in chess, I would venture to say like 100 out of 100 times they're going to beat me, right? And they're going to beat me in like a certain number of moves, because when I play online, or even I play against people that are much better than me, like you don't even come close. Whereas in poker, uh, because of chance, I might be able to beat the top poker player in like one hand, or in like one match per se, just because I got lucky cards, right? And I think because of the way that um, there's so many variables going on in the world that we live in right now, there's going to be people that are very smart investors that just get caught, right? That's just a reality. Um, so I'm going to start going down a rabbit hole that I don't want to. So that's why I'm going to just kind of pause and stop right there. But just to kind of summarize, and hopefully this wasn't too much of a ramble, but a lot of why I'm doing this, just so you know too, is like when I read a book, or I find something that I think is really interesting, that's either going to help me, help my investors, help other people, I want to share it. I want to practice kind of saying it and figure out, is this going to help me? And I believe this type of book, this type of decision making framework, if you will, thinking in terms of probabilities, understanding that there are risks outside of my control, I think is really helpful. And so that's why I wanted to just kind of share it with you. So that's all I got. Have a great week, and we'll see you next time. Bye for now.